Semis are pacing for the best year since '03, only up 62% year to date.
How sad.
You can't fault Wells for saying, you know what, maybe we should downgrade the sector. It's been such a great run. I don't know if it's sustainable or not. But what are your thoughts?
I don't want to front run the growth versus value thing that we might do later, but I think there's too much attention being paid to the calendar. And just because something has done well for a certain amount of time doesn't mean that it has to stop, and vice versa. We should pay attention to valuations. We should pay attention to how far something has run. But if we're heading into a year where we still expect a trade deal, we think phase one gets done, we think that the economy is stable here and that we've bottomed both here and abroad, you can't really make the argument that tech isn't going to keep going. Tech probably keeps going, especially if we get a trade deal.
All right, Jim, tech's best sector of the year. It's up 45% year to date. NASDAQ's the best of the three majors. You look at the chip stocks, some of the names Pete called out, Micron, highest level since July 18, NVIDIA, highest level since October of 18, Skyworks, highest level since the winter of 17, Lam Research, a new all-time high. I could go down the list with more names, but I've already made the point.
You have made the point, but let me take it one step further, because the chips are a good place to use as a barometer for the overall market. There's something for everyone in the chip sector, all right? If you want value, you got Intel, all right? Take a look at any valuation there, that's value. You want hyper growth, you got NVIDIA and AMD. You want something in the middle, something that was value and is now becoming growth at a reasonable price? How about Corvo or Skyworks or things like that? And the point I'm trying to derive from this is that the semis are indicative of the market overall. I don't think we have to say value versus growth or growth versus value. They're both going to work right now. The more important thing, Scott, is where are the funds of flows right now? We've seen flows coming out of equities for so long. That hasn't stopped the rally. What do you think is going to happen if flows start flowing into equities?
Why are they both going to work? I mean, we can have this conversation right now.
Well, they are right now.
Yeah, but how long is that going to last?
Well, you know what? How about this? Because I don't know the answer to your question. It's a good question.
Well,
but
how about because there have been other times where value's done well and then it sort of petered out.
Yep.
Here we are with a lot of predictions coming forward now that it's all about value. All about value in 2020.
I think the fundamentals.
These tech stocks are telling you maybe it's all about growth.
I don't think so. I think fundamentals here support it. And Liz, I think you were saying this, that with phase one behind us, think about what first quarter earnings reports are going to be. The reports themselves might not be so great, but the guidance going forward, that's where you should be looking to our companies saying, hey, we feel better. All right. We're going to get back on the balls of our feet. We're going to start expanding. We're going to start buying IT. And by the way, OK, this is important, right? CapEx is supposed to pick up. Where's CapEx going to get picked up? In IT spending, whether it's computers, whether it's robotics, whether it's software. That's where CapEx is going to get picked up.